Most people think long-term care is something that they can deal with later, but the reality is that long-term care costs are one of the biggest financial risks families face as they age. Traditional long-term care insurance has become more expensive and harder to qualify for, and many people avoid planning until it's too late. That's where hybrid products, life insurance with built-in long-term care and chronic illness benefits, are changing the picture. These policies can protect a family's assets, guarantee a death benefit, and give people the ability to access funds if they develop a chronic illness or need ongoing care. And they solve the biggest consumer fear with long-term care. What if I never use this? Today, we're joined by Marcus Watson, brokerage director for MassMutual's Pelora Group in Charlotte, North Carolina. He's helping advisors across the country understand why hybrid products are becoming one of the fastest growing solutions in the protection marketplace and how they can help clients, like one that we went over recently, Catherine, a 56-year-old professional who recently secured a hybrid policy with chronic illness benefits and lifetime no lapse guarantees. And he joins us now. Welcome, Marcus.
Hey, Jamie, thanks for having me today.
Thanks for being here. All right, so
Yeah,
let's just start out. A lot of people don't really understand long-term care insurance, let alone what a life insurance long-term care hybrid policy actually is. So, what's the simplest way to explain how these policies work and why they're becoming so popular?
let's start with the second part of your question, why they're becoming so popular. I think to your point, you've seen the market shift really not only in what consumers are looking for is the ultimate flexibility, because you and I both know you can't really predict the future. You just got to do our best to help educate the clients on some of the pitfalls that exist out there. So I think we've seen them grow in popularity because of the like you mentioned, the ultimate flexibility of what happens if I don't use it, right? What happens if life goes as planned, right?
Mhm.
And so I think that's where we've started to see not only from the consumer side of things, but we've also seen the carrier shift and all the different companies that play in this hybrid space shift their product designs too. So, like for example, with MassMutual, they just launched their new UL Guard product that for the clients that are under 65, they have the ability to have that chronic illness rider included on the policy to really be there to help hedge the long-term care risk. And I think that's the biggest thing of why we've seen the popularity with the hybrid products, whether it's a long-term care rider or a critical illness rider. It's to help with the long-term care hedge in addition to have death benefit in place so that if something happens, it's there. But if life goes as planned, the estate plan is intact and you have the death benefit at the end of the person's life. Because as you and I both know, Jamie, death is undefeated, right? And it's just a matter of how we get from, the working era to the retirement area to, hey, we're in the twilight years of mitigating the risk along the way.
Yeah. I mean, I remember early in the business, they always said there's really three things that happen to you. You either live too long and outlive your assets, you die too young, or you become disabled or really sick along the way. So, it sounds like this is kind of the type of product that can solve all of those potential problems.
Well, and I think that's what with any life insurance hybrid solution is to create that ultimate flexibility and options. And I think that's what any consumer is looking for is the most options and flexibility based off the product. So whether you're using a traditional, Mass actually has two different outlets of they have the uh, long-term care access rider that we can access on all of our hybrid whole life solutions. But then we also have the guaranteed UL product with the chronic illness rider. So it's really gets down to understanding what the client's goals are and understanding what's their biggest fear, right?
Mhm.
You've touched to, hey, is if their biggest fear is, hey, I know that I want to make sure that I have a death benefit in place that benefits my kids. And then, hey, if the secondary goal is really the long-term care, hedge or understanding, hey, if something happens to us from a critical illness, having those dollars out in front of our estate is important. Then you have different options of which way you can go. And in particularly, I think the biggest sort of aha moment that we're seeing, even from the carrier side of things, is also giving the clients the flexibility to be able to pay it on the schedule that they want. So, really working with financial planners like yourself to educate their clients, it's, hey, we also don't want to be paying on this contract forever. So, you have the flexibility of being able to do, hey, I want to pay on this one time and get as much risk management as we can, between the death benefit, the long-term care, and then even on this new UL Guard product, we have an enhanced surrender value rider, which is a version of getting a portion of their premiums back, depending on how long they can execute on that. So it's really designed to create that flexibility and create the options for the clients of figuring out what's important to them in relation to their financial plan.
So, what is the ideal profile of somebody who could benefit from these types of policies? Like, what
I
are
think
the,
the scenarios that we've seen most is the folks that are in that 50 to 65 range. And I would call it the sandwich generation. And I know you've seen several of these folks in their practice. Hey, they're still raising their kids, trying to get their kids through college, but then also they're taking care of their parents, right?
Mhm.
So it may be in a situation where, hey, we want to go ahead and hedge this piece of our estate plan, knowing that, we're going to have, responsibilities coming at us from both generations on either side. I think the second scenario too is we've seen a lot of business owners look at this product because of that critical illness rider. So the business owners that are getting ready to sell their business or have sold their business, that are in their mid to, late 50s, this is an ideal sleeve for that person as well, because they can have those limited pays of, hey, we just got this big outflow from the sale of our business, right?
Mhm.
And let's go ahead and hedge that long-term care and estate planning risk, but then also be able to use and partner with your advisor to manage the assets in the manner that they want to do. So it really gives them the flexibility of deciding which parts of their risk profile do they want to self-insure and which ones do they want to push off to the insurance company.
And this could be paid for through a business, unlike other types of insurance where it causes taxability, correct?
Yeah, so it can be entity owned. So there are some different advanced sales designs, and that's where we work with our advanced sales attorneys at the home office to really understand what the client's trying to accomplish and figure out what's the best solution with in working in relation with their advisors, their CPAs, their attorneys to figure out, hey, where does that sort of come together to help align the product with the client's goals.
Okay. So let's take a look at the case that we did together. It was Catherine. She's 56. She's married. She's an emergency physician in Pennsylvania. She has a wife. They're both healthy. Their kids are grown and they plan to retire in about 10 years. We did $1 million death benefit. The premium was, I think, $18,000 a year. So give me the scenario of, again, she lives too long, she dies too young, or she becomes disabled. Give me all three types of scenarios, how this works for her.
So I think the simple and foremost part is the once she passes, right? It's permanent death benefit that's put in place. So it gives the client the ultimate flexibility to be able to control her cash flow from now till whenever that time is, right?
So the
I think,
premium is fixed, guaranteed,
yeah,
right? Okay, so
yeah.
that's not going to go up. Okay.
And the guarantees that are built into the contract is it's guaranteed to age 121. And that's
Okay.
how the contract is issued as at a default. So the client could live to 120 years old and the death benefit is still in place. So that's
Wow.
where a lot of the attractiveness of that contract is, because first and foremost it is a life insurance contract.
She better name like her great great grandkids as
Yeah, she'll
money.
be able to have the control of deciding where she wants that money to go. It could be to a
Yeah.
charity of her choice, it could be to family, it could be nieces, nephews, great
Mhm.
grandkids, grandkids, however she wants that. And it can be even a trust that could be assigned the beneficiary.
Okay.
So there's a lot of different options of that. So I think first and foremost, that's hey, you live too long, right? Because you have the guarantees built into the contract of as long as the premium is paid, you're going to have that coverage in force. I
Okay.
think the second piece is, the hedge from the critical illness side of things. So if she becomes to the point where she can't perform two or more of the activities of daily living, um, that could activate the critical illness rider, where she could access part of the death benefit to be able to use that for care, to put that as a guard out in front of her other assets from a liquidation event. Because, like you
How does that work? So if something happens to her in year 5 versus year 20, is it a different benefit amount that she would receive?
Correct. It's a sliding scale. It's based off a formula of what year she needs to activate the contract. And we educate the clients, and when I say we work with you to educate the clients of, hey, here's the sliding scale from 65 all the way to 85. It's a different amount based off of how long, what you have to use and how much you have access to. So it's a
So it's an
percentage.
indemnity benefit. So if something happens, she's 75 and she has a stroke. She buys it at 55. She's 75 and she has a stroke. How much can she access?
So the key point would be is if she can't perform the activities of daily living as a result of that stroke, and that's determined by the client and their doctor.
Okay.
And so that, I think, is the important part. And then it would be a percentage at 75. I think there's a sliding scale, but it's roughly about 75% of the death benefit that she could access,
Okay.
up to $200,000 of
Okay. So
death benefit.
in that case, she would probably get the full $200,000 and she could use it, or her people who have medical power of attorney can determine, do they want to put her, do they need home health care? Do they want nursing care? There's no restrictions on how they use that, correct?
Correct. Yeah, and then we always recommend to also get the CPA involved to make sure that they're within the IRS daily limits and those type of things. So because it is, there is some reporting on the back end, but you are correct, Jamie, is you have the ability to access part of that cash value. And more importantly, like you saw in this case with Catherine, there is then death benefit left over.
Hmm.
So that's the second piece of back to the first thing is, hey, we've had a life event. Life hasn't gone as planned, but there's still options for ways to access money and the ability to still leave a portion of the legacy to even help with final expenses and stuff there beyond.
So
So
she takes out 200,000, or the family takes out 200,000 to provide her care. She passes. The balance, 800,000, would then be paid to the estate still.
yeah.
Okay.
Yeah, and that is, and on a case by case basis, that can be shown in the illustration of, hey, this is how much money would be left over, from a death benefit perspective. So again, really, and then like the last piece of it there is, especially in Catherine's situation, once the policy reaches policy year 25, she has the ability to also make a decision if she wanted to get portions of her premium back, if not 100% of it back, with the enhanced surrender value rider.
Okay.
So that is
Well,
built
let's
in.
say she takes all of her premium back. Does it start from now she's, you know, 55, now she's 80 years old. Let's say she decides to get a premium refund of everything that she paid in. Would she no longer have the critical illness
Yeah, so
available?
that's the trade-off of you get your premium back, but at that point you don't have any death benefit or access to the critical illness.
You're
So
cashing the policy in.
correct.
Okay, so she could get, so let's say she paid in, I don't, my math isn't great off the top of my head, $250,000. She would just be able to take that, and then if she wants to, use it for whatever she needs it for, she can. Or she can take half of it, let's say she takes 125,000 of it. Would she still have a portion of the policy still available?
No, so that's the part of the rider that, it's really that position point of that's where you guys as planners comes into play of figuring out, hey, what's more important to you now? Hey, when we put this policy in place when you're, all the way back to a year and now we're 25 years down the road, what's more important? Do we need that liquidation event for some reason of, hey, let's go ahead and get our premiums back, or do we want to just keep the contract in place like we agreed upon because your life goals and some of the things that you're trying to do with your financial world are still in alignment with the same goals that when we put the policy in place. It just gives, again, back to that. I think I really enjoy this product because it does give that ultimate flexibility to the client in ways that we haven't seen before in that UL guard space. Because I think when you and I talked about, that's probably one of the biggest frustrations across the industry is, hey, it's guaranteed death benefit, but sometimes clients get upside down on those contracts by living too long, right? So then you have that flexibility to be able to educate your client on the different riders that are issued with the contract, to create that flexibility in their plan.
Yeah. We're talking with Marcus Watson of MassMutual's Pelora Group about how life insurance and long-term care hybrid products are helping real people protect their families. When we come back, we'll talk about what clients misunderstand about long-term care costs, how hybrid solutions can create flexibility that traditional long-term care insurance can't. Stay with us. Pause for a couple seconds. All right, we're back with Marcus Watson from the Pelora Group, who is talking with us today about long-term care life insurance hybrid products. So something that came to mind when we were talking is I know in the long-term care space, there's a lot of safeguards because, we have to look out for people maybe later on who may or may not be able to make some of these decisions. And, we've always talked about, be nice to your children. They're the ones that are going to be handling your care or picking your nursing home. But I think that that comes into play here. Are there safeguards? Do you name certain people who can help make these decisions? How does that work?
Yeah, that's where you work with the experts around you. So I think a lot of times what I enjoy partnering with is financial planners and brokers and different people that, hey, when you surround your client, you surround them with all the resources, right? So the power of attorney, they can, having those on file with any carrier. So whatever policies and those type of things that you're doing, working with your attorneys and working with your CPAs to understand, hey, here's some of the things that we need to make sure that are in place, especially when you're talking about long-term care. And I
Mhm.
would say that at a very high level, Jamie, is, you know, anytime that you're doing long-term care planning with anybody, that needs to be, first and foremost is who needs to be a part of this conversation, who needs to be helping you with this decision because it's going to affect them just as much as it is you, right?
Mhm.
So, and I think a lot of times that's why clients are coming and asking about long-term care solutions because, like we talked about before the break, that sandwich generation. They don't want, these are folks that are looking at this stuff that have had to take care of their parents on a some level of, you I know a couple of my clients that have had to, actually have their folks living in their homes with them to help
Mhm.
take care of them. So, and they say, hey, I don't want to do that to my kids. I love taking care of my parents because they took care of me forever, but I also don't want to do that to my children, right? So it's really, I would say the industry has done a good job of adapting with the long-term care market from, giving the clients that flexibility to be able to plan how they want their twilight years to go. Because, like you said, hey, we are living longer, right?
Yeah.
And so I think anybody who's doing that planning, it's important to have what I call those beneficiary review meetings of, having a meeting once a year, whether you're doing the annual review, from the money side of things, but doing a annual policy review to make sure, hey, are these still the beneficiaries we want? And then even inviting those beneficiaries to be a part of that discussion. So then that way everybody's in, on the same page of what's going on. I think one of the things that I try to do with our clients and I help our brokers, implement this within their practice is, you know, get to know the beneficiaries because the first time meeting them, you don't want it to be in a time of crisis, right?
Yeah.
And so then that way it's really back to the add value that you can drive through your practice. But more importantly, it allows the clients to feel like they've made an empowered decision, but more importantly, it's the ongoing relationship. And I think that's the part of these contracts that people forget is, hey, you need to be doing the annual touch base, the annual check-ins to make sure that, hey, is this still fitting? Is this still in alignment with what you're trying to accomplish from a financial side of things?
Yeah, and that's something that I've always told clients. I mean, clients come to me for life insurance, and I tell them, you really better tell somebody else that this policy is enforced, whether it's your attorney, your beneficiaries, et cetera, because if you're gone, they may not even be aware that it's available and you're not there to tell them. Which also leads me to something else that we didn't really touch on. And you had mentioned activities of daily living. And I know that another big piece of this is also cognitive impairment. Can you maybe touch on that a little bit about how that comes into play?
Yeah, I think the cognitive impairment is one of those situations where, you don't have to be in your late 60s to have cognitive impairment. I think you do quite a bit in the disability insurance space, educating clients around, hey,
Yeah.
the disability risk. Mental nervous is, one of the top claims in the disability space now. And so you see some of that transition into, you know, daily life, no matter what age you are. I'll share my personal story. My dad at 53 had melanoma brain tumor. Couldn't operate his practice, couldn't operate his stuff. So yes, all of that kicked into play of, the different protection strategies between protecting his income and the activities of daily living. It was a struggle even from a cognitive impairment because, when you've had a major brain operation, it takes you a while to get some of that stuff back, if at all. So that's sort of a day in and day out real world example of, hey, these type of things happen. Life, it's awesome if life goes as planned, right?
Well, that's actually really interesting because a lot of my clients that are coming to me looking at this product are in their 50s. And so they still have their disability policies during their working years. And so they're kind of figuring out as I let go of my working years and go into my retirement years. But let's say like your dad had a disability policy to cover him, while he's working, but maybe he also had this type of hybrid product as he was planning. He was in his 50s. How would some that scenario come into place? Would he file
Yeah.
claims for both? I mean, how would that work?
Well, and it's a coordination, right? So I would say in this scenario, with my dad, he made the decision he didn't want a hybrid policy. He had permanent, just regular UL Guard with no critical illness rider because he had that disability policy that would cover the income, but then also, the different waiver of premiums that are on permanent policies across all carriers.
Yeah.
So then again, sort of I think I can't lean into this enough and say, hey, it's really based off your individual situation. So we have a lot of clients that come to us for long-term care, but it ends up being more of a traditional estate planning play. So in this scenario, we've seen a lot of folks that decide, hey, I'm going to just keep my group disability through my company and really spend my extra premium dollars investing in something like this because in the event of an activity of daily living, I want to make sure that one, I have some death benefit in place, but then also, you know, we have that part hedged instead of a long-term disability plan that takes you to paying benefits to 65 or, 67, age 70, depending on the carrier. That'll allow you to sort of make that plans of, hey, which part, again, back to one of the conversations I love having with prospects and clients and brokers and advisors is which parts of your protection plan do you want to self-insure and which parts do you want to push off to the insurance company?
Hmm.
And so that gives you that flexibility of just using a simple example like that of deciding, hey, I want to push off the risk of losing my income to the insurance company and then hedging my death benefit as opposed to the flip of, hey, I really want to hedge the long-term care piece
Hmm.
and the death benefit. I'm less concerned of how we get there from a income perspective. So,
And it's interesting. So it sounds like it's pretty nuanced, and it really depends on how much people have saved, how much debt they paid off, maybe how old their kids are. Are they up and out, or are they still, you know, at home for a long period of time? And so it sounds like when you're kind of letting go of the disability and taking on the long-term care almost becomes more of a catastrophic type of scenario if something
mhm.
happens, where it's going to cover the activities of daily living as opposed to maybe a partial disability. You have migraines or back back surgery or something of that nature. So it sounds like it's becomes more of a catastrophic kind of risk.
And you're 100%. It's based off of each client's individual situation is different. How well did they do from a savings perspective?
Mhm.
Hey, do we want to self-insure that piece of, hey, I'm 62, I only got 3 years left of retirement. Do I really want to continue to, pay on my disability contract? Or should I look at something with some long-term care, hedge play,
Yeah.
whether it's long-term care rider, a critical illness rider, any of those type of solutions that all these carriers have. It's really taking a comprehensive look. And I think that's the piece of where, and what I've seen, Jamie, I know at our firm and then within your practice and some of the other advisors that I have the privilege of working with, that's where you as planners understanding your client's individual situation and digging in and then bringing the right solution to them. And that's what I enjoy about my job is being able to be that product expert to be able to help. Hey, this is where this fits in this situation.
Yeah. And I've also had a lot of clients come to me saying, my siblings and I together, we want to insure our parents.
mhm.
We want to protect our inheritance. That's really what this is. Is it too late to get one of these products if somebody wants to start it when they're in their 70s or 80s? The kids want to buy it on their parents. Is it too late or is it not as cost effective?
Well, where we've actually seen some play in this, Jamie, is part of the new UL Guard that rolled out also has a survivorship aspect to it. So you can issue it on a husband and a wife in a traditional survivorship situation where, we've seen cases that we've worked on where the trust is the beneficiary, right?
Mhm.
They've done their proper estate planning. They're less concerned about like a cash accumulation that you would have with an IUL or a whole life contract. And it's more, hey, I want permanent death benefit and less concerned about the cash buildup. And more importantly, it's really when both parents go, being able to have that, estate equalization
Yeah.
situation.
So, looking 5 years ahead, do you expect these hybrid life types of policies to kind of overtake traditional long-term care policies? Like, where do you see the marketplace looking ahead?
Yeah, and this is my opinion. I think we're going to continue to see all carriers, including MassMutual, continue to be very competitive in this situation, especially in the limited pay. And I think that's what when MassMutual rolled out this new UL Guard product with the pricing perspective. MassMutual had a UL Guard product prior to, but really wanted to be competitive in the limited pay situation. So you can get that guaranteed to age 21, but maybe only pay on it for 10 years
Hmm.
of 10 years of premium. So it gives that flexibility to be able to do that.
Yeah. Well, thank you so much. This has been really illuminating, providing all of this information. I think it's still relatively new, but I'm getting a lot more requests for information about this. So I appreciate you taking the time to talk to us today. And thank you so much.
Thanks, Jamie.